And good evening, ladies and gentlemen, boys and girls, puppies and kittens that are listening this evening from whichever living room around the world you are in. Welcome to Foundations of Stocks and Options. Tonight we are here live, coming to you from Nashville, and thrilled to be here. And we got some awesome stuff to jump into tonight as we're going to be resuming our discussion on options trading, rounding the corner. And so tonight's agenda is going to look like this. We're going to have a review of stock options, talk about options as an insurance policy, and then options as speculative investments or speculative trades. So some really cool stuff we're getting into tonight. It's actually the first of the next three classes, which are all dealing with options trading, and going to try to bring some clarification to this seemingly complex subject that we call options. How many of you guys had the opportunity over the weekend to start working with your trader conditioning and doing some back trading, testing your stocks there? That was a great opportunity for you this weekend, and I see some yeses coming in here. So Edmund was the first to respond, and Randy and Shirley, and I got Preston in here saying he did it. How many of you felt like in a fairly short period of time you learned an outrageous amount of stuff? Isn't it amazing what you can learn if you just sit down and you take the time to go through history and see what historically has already happened? Because here's the crazy thing. The future, while it's not always a direct reflection of the past, it's usually at least a good rhyme. And I kind of messed the quote up there, but that's something to the effect of what Mark Twain once said about the future. He says, history doesn't always repeat itself, but at least it rhymes, something like that, right? Anyway, awesome tool, the tool of historical replay, historical back testing. Trader conditioning system is definitely going to make you guys a much better trader no matter where you are. Now, once, of course, you have learned how to read the market, once you've learned how to pick a direction, are we going up, are we going down, are we going sideways, it's very critical that you learn how to apply the right strategies. And so options trading is going to be one of those strategies. Now, options trading is not for everybody, but it is an incredible way for a lot of you to leverage what's going on in the market. And I'm just going to teach it. And if you connect with it, great. If you don't connect with it, then you can decide which strategies you want to use. But for me, I'm personally an options trader. I trade options almost exclusively, and that's just the nature of who I am as a person and as a trader. A lot of our students, they just don't like them. They're just not into options, and so that's totally fine if you're not into the options world. Tonight, what I want to do is I want to do a quick review of what we've learned so far. If you remember, it's been almost a little over a month, actually, since we talked about options trading, and that was in class number 7 and class number 8 from level 1. So it's been about 5 weeks ago that we talked about that, maybe 6 weeks ago, depending on how it fell there. But anyway, so I want to give you a quick recap, and then what we're going to do tonight is I'm going to specifically talk about using options as an investment. Rather than just as an insurance policy, rather than just as a hedge, we're going to talk about trading them, actually trading the option itself. All right, so as a quick review here, let's jump into it. We're going to fly through this quickly. What are stock options? Stock options, or I should say an option, gives the buyer of the option the right but not the obligation to buy or sell a specific stock at a specific price on or before a specific date. The right but not the obligation to buy or sell specific stock at a specific price on or before a specific date. Now, this is a very specific definition, if you guys take note here. And if you really want to clarify what the definition of the option is, it is the last portion here. You can just scratch out the buyer portion, understanding that the buyer is buying the option, but the option itself is the right but not the obligation to buy or sell a specific stock at a specific price on or before a specific date. That's what we're dealing with when we're dealing with options. Okay, so there's two types of options. We already learned these two types. They're the call option and the put. The call option gives you the right to buy a stock at a certain price, and a put option gives you the right to sell a stock at a specific price. Right to buy is the call, right to sell is the put. Now, there are two sides of the trade. Those two sides of the trade are the buyer and the seller. Buyers and sellers. There's always going to be a buyer and a seller involved, or else the transaction is not taking place. So in order for this to all transpire, there's going to ultimately be 4 trades. Remember, there's 2 types of trades, the call and the put, and there's 2 sides, the buyer and the seller. So you can buy a call or you could sell a call. There's two positions that you could take right there. You could buy a call or you could take the position of selling the call. And you could buy the put or you could sell the put. Buy a call, sell a call, buy a put, sell a put. These are the only trades that are available in the world of stock options. Now, here's the crazy thing about it. These four little simple trades combine together to create what seems like an endless layer of stock option strategies. There's just tons and tons of strategies, incredible different ways that you can implement these things. But it really comes down to these four basic trades: buy a call, sell a call, buy a put, sell a put. All right, so if we expand our definition just a little bit, remember the definition of the option is the right to buy or sell the right but not the obligation to buy or sell a specific stock on or before a specific date. That is the definition of the option. Now, the buyer of that option is buying that right. Okay, so follow me here. The buyer's buyer and a seller. The buyer is purchasing the option. So the buyer is purchasing the right but not the obligation to buy or sell a specific stock on or before a specific date. The seller is selling that option. The seller is selling the right, but not the obligation to buy or sell a specific stock on or before a specific date. Who is the seller selling it to? The seller is selling it to the buyer. Consequently, in the process, the seller becomes obligated. So the buyer is purchasing the rights, the seller is selling the rights. In the process, the buyer gets all the rights and the seller becomes obligated. Now, we got four types of trades: buy a call, sell a call, buy a put, sell a put. Two types of options: the call and the put. Two positions, the buyer and the seller. You put it all together, and here are the four ways that the options can be played. When you buy a call, you end up with the right to buy the stock. That's trade number one. Let's mark it over here in the middle. Trade number one. That is when you buy a call, buy the right to buy the stock. When you buy a put, you buy the right to sell a stock. That's trade number two. Now, the other side of the trade, this is the buyer side. The other side of the trade is the seller side. The seller, remember, is selling to the buyer. Says the buyer has purchased the right to buy the stock. In the case of the call option, the seller has become obligated to sell it. So whenever you buy a call, you have the right to buy the stock. When you sell a call, you're obligated to sell it at that specific pre-agreed upon price. The opposite is true for the put option. We'll call that trade number three. Trade number four is when you sell a put. When you sell a put, you are obligated to buy the stock. Why? Well, because think through it. What is a put? A put is the right to sell. You sell the right to sell to the buyer. The buyer receives all the rights. The seller has become obligated to purchase that stock. Okay, it's really not a complicated subject, but I do realize that sometimes it requires some mental gymnastics. And so the best thing you can do is stare at it a long time, get it kind of in a conceptual idea, and then go to your virtual accounts and just trade the heck out of them until you start figuring it out, and it will come into clarity for you, okay? Action, very oftentimes, action is the only thing that's standing between you and understanding what we're talking about sometimes. Okay, now here's what I want you to understand. In the new version of Foundations of Stocks and Options, in all, I actually have 5 classes that are dealing with options. Okay, now in the old version, we only had 4. So I've added a whole class to options, and I've also simplified the amount of content that we're covering. I'm not going through as many strategies in Foundations version 2, the one that we're working through right now. Instead, I'm really digging into these basic strategies. So hopefully by the time we're done with all of this, you're really going to have an extremely solid foundation in terms of options trading. Let me show you what we've been through in case you need to review level 1, class 7, and level 1, class 8. This is the intro to options, and class 8 is when we got into the covered calls and the option chain. So this little grid here will kind of show you where the information is so you can go back and reference it. Now, tonight we're getting into level 3, class 3. And tonight we're going to be talking about buying calls and buying puts. And we're going to specifically be talking about options as a speculative trade, buying calls and buying puts, and options trading. Okay, class number 4, that's the next class. We're going to get into option pricing. So this is a big question that a lot of you have. And I'm telling you right now so that you know as we go through tonight, you're sitting here saying, well, how do you figure the price out? Don't worry about how you figure the price out tonight, because we're going to learn about this in the next class. We're going to talk about the components of pricing. I'm going to teach you about the Greek Greeks, and we're going to talk about price movement. We're going to do some calculations of how you figure out how far your option price should move in relationship to the stock. And then in level 3, class 5, which is a week from tonight, we're going to get into option orders and trade setups. And we're going to actually go through and place some trade orders, go through all the details basically. Do the analysis that we've been learning about in level 2, and then how do we apply that to the option and whatnot. So this is where we're going. That's what we're breaking into, so that you kind of understand and you can see the picture. Because I understand that when you're learning options, either for the first time or just period, it kind of becomes a deep sea that you're swimming in. And if you're not really clear on where you're going and you don't see a clear path to the end, you might feel like you're treading water for a long time. The best thing you can do while you're going through this the first time, best thing you can do is sit through the classes, take your notes as much as you can, do the quizzes, take the action and the homework, and go to the next class. Then when you get done with all of it, you'll have the basic concept, you'll have a framework, and then you can go back through, and I promise 2, 3, 4 times going back through these classes, you'll be surprised at what you missed the first time you went through them. Okay, there we go. Let's get into it. Enough with review, enough with laying the foundation here. Why do my slides keep going backwards? I'm obviously doing something wrong. All right, let's talk about options as an insurance. Now, what are options as insurance? I wanted to start here in my discussion with teaching you about speculative trading by laying the foundation of what the option is in its pure essence. In its basic, most primitive form, the stock option is designed to limit risk. It is an insurance policy, or in the world of trading, we really call it a hedge. Now, what is a hedge? A hedge simply offsets your trade. In the event that the trade goes against you, the hedge is going to offset it. It's not necessarily going to be a perfect hedge. You still can potentially lose some money on it. But if you've got a hedge in place, then what you've done is you've set up a situation where you've got a much more limited risk situation. Now, as an investor, and specifically when I say an investor, a stock investor, you can use an option to hedge your stock investment, your stock trade. You can use it to lower your risk. And that's what stock speculators and stock investors want to do. Now, let's just rewind. And by rewind, I mean let's go back in time several decades ago. Let's go back to the 1930s and 40s and 50s. And if you get into 1930s and 40s and 50s, stock options were not household words. You did not know about these things. That did not mean they did not exist. In simple form, what happened is you had traders who were using options. They were using the concept of options, but they were a much smaller scale, and pretty much you ended up taking on a position and not necessarily having a whole lot of liquidity. Now, what is liquidity? We've talked about this before, but I'll just roll it out here again. Liquidity is the ease with which you can get into or out of a trade. Okay, it's how liquid is the stock, or in this case, how liquid is the option. Okay, so liquidity is the ease with which you can get in and out. You get in and out. Okay, it's the ease with which you can get into and out of a trade. Now, you can imagine a scenario. Let's just fast forward or rewind 50 years ago, and if we were sitting on an exchange 50 years ago and we were trading an option, and let's say it's myself and Laura. And Laura, being one of our students, she learned about how to trade options, and she came along and she said, "Hey, Jeremy, I bought some stock, but I want to lower my risk, so will you sell me a put option?" And I say, "Sure, I'll sell you a put option," because I looked at her trade and I thought, oh, there's no way that trade is going to go down. And so I thought, sure, I'll insure that position for Laura. Well, sure enough, the trade starts to go down. And what do I start to think? I start to think, oh, shooky dookie, this is bad. What am I going to do? And I'm looking, who can I offload the option to? And I can't, because there's no liquidity. Okay, so along comes the 1970s, and along comes the CBOE. And who is the CBOE? CBOE stands for Chicago Board. Boy, I really should have done this differently. That's hard to write that way. We'll do it this way. I wish I'd quit writing an E first. CBOE. There we go. Chicago Board of Options Exchange. Now, what is The CBOE. What is a Chicago Board Options Exchange? Well, the key is in the last two words right here. Chicago Board simply means that it takes place in Chicago. But the options exchange, the key word being the exchange, took the idea of options trading and put it onto an exchange. Now, what does an exchange do? You're familiar with an exchange, whether you realize it or not. The New York Stock Exchange is the location where the stock changes hands, right? The NASDAQ is a stock exchange. Chicago Board is an options exchange. And what the Chicago Board Option Exchange does, or CBO, or CBOE as we call it, what they do is they become the central clearing place where all the options trade. So you see, what we could have done maybe 60 years ago is John and I could have got together and John said, hey, look, Jeremy, I want to insure this stock position at exactly $89.33. Would you do it for me? And I might say, sure, John, you pay me this much premium and I'll do that for you. And it might have been, instead of for 100 shares, it might have been for 32 shares. And we wrote a contract to each other. Well, the problem was that was a deal between me and John. And if I wanted to get out of it, or if John wanted to get out of it, there was no liquidity. There's nobody else to sell that deal to. So what Chicago Board Option Exchange did is they came along. I probably should have had a slide for this. It's some interesting history, I suppose. Anyway, what they did is they came along and they said, we're going to, number one, standardize. We're going to standardize the options. So instead of being random, instead of being non-standard, they're going to be standardized. And by the way, that's one of the functions that exchanges do. Exchanges standardize things. Okay, so what are the standard aspects of options? First, let me just roll through some of these here. And now that I'm teaching this class for the first time, I think I might add this sequence of slides. Well, I'll let you guys tell me. After we're done with this, you can tell me if you like this discussion. All right, so the standardizations of options. Number one, most important, it's 100 shares equals one contract. Okay, so instead of getting into awkward contracts, Chicago Board says, hey, let's make it simple. One option contract is going to be 100 shares of stock. That's it. No 89 share contracts, no 231 share contracts. They're 100 shares, period. Okay. Now, next thing that they did is they came along and they implemented standardizations in terms of expiration month. Expirations, okay? And, of course, that expiration is typically the third Friday of the month. Now, as options trading has become more popular, they started adding additional expirations, and now we have weekly expirations for a lot of stocks. But typically, it's the third Friday of the month across the board, okay? They also came along and said that stocks need to be more than $5. More than $5. They also came along and they had strike prices. Our standard. And we talked about standard strike prices way back in class number 8, so you can reference that. But typically speaking, I'll give it to you really fast here. Typical standardization for stock prices, or for strike prices. If a stock is $5 up to $25, it trades in 250 strike increments. $25 up to $200 is going to trade in $5 increments, and $200 plus is going to trade in $10 strike price increments. So that's typical standardization stuff that CBOE does. And then the other factor, let's see, is there anything else that I'm missing in here? Standard 100 shares, expirations, strike prices are standardized. They used to have quotes that were standardized. It used to be quotes would only move in 5-cent increments, but now that's changing as well. I think I got the biggies there. Anyway, bottom line is what exchanges did is they brought a standard to options trading, and by standardizing the options trade and then sticking it on the exchange so that other people could trade it, what happened is it created a lot of liquidity. Okay, so let me write that up here. Exchanges brought, we'll put equals, but it brought liquidity. Now, what does it mean? It means that I can strike a deal and I don't ever even have to meet John. I don't ever have to meet Laura. I just go to the exchange and say, hey, I'm willing to sell this contract. Anybody that'll buy it, I'll sell it to them. And if I want to buy one, I go to the exchange and I say, hey, I'm willing to buy this contract. Anybody that'll sell it to me, I'll buy it. And then we say, okay, that's fantastic. So the exchange is doing the work. The exchange becomes the middleman, Okay, and the exchange is matching all the buyers and sellers. Now, ultimately, inside that, you've got market makers, and then you've got the brokers that bring you to the exchange, but that's getting into all sorts of details that you really don't need to mess with too much with tonight. Bottom line here is that the exchange makes the facilitation happen so that we have the privilege now of trading these option contracts. Now, what are these options? These options are, simply put, the ability to offset risk. In other words, it is an insurance policy. It's an insurance policy. It's a hedge. And it's a logical hedge. I mean, anybody who jumps into a stock trade, sits here and says, hey, I got all this money in this position. I'm concerned that this trade could go against me. I want to protect myself. Or better yet, what about the short trader? You see, the short trader is the trader that really understands the risk, because we understand that if you're in a short trade, let's say that you jump into this trade over here, and that was a logical spot. I mean, by the time you saw this thing, it looked like it was going down, right? You jumped into the trade and realized that back here we had all sorts of bearishness. So you really thought this trade was going down, and it did trigger. It did start to go down. It bounced. It came back down. But then before you know it, it formed a double bottom, and it started to take off. And if you're in a short trade, you're crying and you're thinking, if I could just go back in time. Why? Well, because whenever you short, what do? You start by selling. You sell a stock short. That's how you open the trade. Now, if you sold a stock short, you didn't own the stock. What did you do? You borrowed it. Okay, so you borrowed a stock, then you went out on the exchange and you sold it, and now the stock's going up, and you are obligated to do what? You're obligated to go buy it at some point so that you can cover your shorts. Well, as the stock keeps going higher and higher and higher, your tears get bigger and bigger and bigger, and you're thinking, oh my gosh, if I could just go back in time, I would have bought it when it was a lot cheaper. And you get the whole little, the shake going. You guys ever have toddlers that do the shake, and then they get really quiet? You think they're done crying. It's like, wah! And they just about to unleash. Oh my gosh, I hate that cry. Anyway, sometimes if you're in a short position, the stock goes against you, you start to cry like a toddler. And you're thinking, if I could just go back in time, there goes all my money. You start to, well, what would be a logical thing to do? What if you had the right? What if you had the right to go back in time and purchase the stock at that specified price? Well, that's exactly what the call option does for you. The call option gives you the right to go back in time, not literally. It just locks in the price. It says, hey, no matter how high the stock goes, the stock can go to $9 million a share. You have the right to purchase that stock at that agreed upon price point. That agreed upon price point is what we call the strike price. Now, this becomes extremely valuable, especially if you're a short seller. And you can see how this hedge would work. The call option, being the right to buy the stock, will increase as the stock goes higher. Let's say the stock runs all the way. Let's say that you had the right to buy it down here at $55 a share, and the stock runs all the way up here to $155 a share. How valuable is that call option now? Well, it's worth at least $100 a share. At least. You say, why is it worth at least $100 a share? Well, because the stock is now trading at $155 a share, but you have the right to purchase it at $55. How valuable is that to you? It's worth at least $100. Do you guys see that? Does that make sense to you guys? Understanding it? So the value of this call option is going to be worth more as the stock increases. Now, if you are a short seller and you have purchased the call option, what happens is you are limiting that theoretical unlimited risk that you got into when you sold short. How are you doing it? Simply by purchasing the right to buy. You see, you didn't buy the stock to cover. You were short the trade. You expected the trade to go down. Your bet, if you will, quote unquote, air quotes there, your bet said that the stock is going to decrease in value. I'm going to short it because I think the stock's going to go down. But what happens if it goes up? Well, if it goes up, I'm not too worried because I still have the right to buy it at a cheap price. I paid that for just a few pennies. I'm not too worried about this. Do you see how you just hedged your position? You see, you jumped into this trade down here. Now you have the right to buy it up here In the event that the worst case scenario happens, you have limited your risk to the difference in the selling price and the price of the call. The selling price is your original price where you sold short. That's the selling price. And since I'm talking figuratively here, I'm not giving specific numbers. You can make up a number and put it in there. But you had your selling price, and then you have your buying price or your call option. Your risk has been limited between these two prices. And that is the most you can lose, period. Why? Because you have a contract with the seller of the call option. If you're purchasing it, the buyer, remember the buyer here, you have a contract that says you have the right to buy. You have the right to buy at that price. Therefore, no matter how high the stock goes, you are good. Interesting. So now your risk has been seriously limited. Now, Frank has said, is that what we call it, a covered call? No, Frank, this is not a covered call. This is buying a call. A covered call is selling a call option, and you need to go back to class number 8 from level 1 where you can refresh on the covered call. Okay? All right, now, let's take an example. Bringing all of this stuff forward here. Let's take a look here at this Texas Instruments trade. Is it logical? I would propose that it is, that as the trade is becoming more and more bearish, you start to see the trade running up here and trades up into the trend line. You've now got 3 touches on the trend line. The most recent one has a bearish tweezer top candlestick formation, and you're thinking, oh, this sucker is going to go down. So what do you do when you're looking at a stock and you think this stock is going to go down? You think, oh, I would like to sell to short, right? I'd like to short this trade. I want to sell, open my trade, make a profit as the stock is tumbling. Okay, so we're going to short this trade at $29.19. Now, what's the max profit we could have? This isn't rocket science. What's the max profit we could have? If you sell it short at $29.19, you want the stock to go down. The lowest it could possibly go is 0. Max profit is $29.19. Now, what's the reality? Are we going to really hit $29.19? Probably not. No. We're not really going to go down that low, but that is theoretically your max profit. What's the max risk? And the answer is, of course, unlimited. This is the short trade. This is the danger of the short trade. The short trade danger is that you sell a stock short at $29.19 or any other price you sell short at. But in this case, you sell short at $29.19. You have a limited or a maximum reward, a max possible profit with an unlimited maximum risk. How is it an unlimited risk? Well, if the stock runs up, let's say it breaks out of this trend line, can it stop at 33? Sure. Could it stop at 35? Sure. Could it stop at 355? And the answer is sure. There is no cap. You see, you have a floor that we call 0. You don't have a ceiling. There is no solid ceiling here. Okay? So whenever you do a short trade, you have a theoretically unlimited risk. Now, let's stop that risk. At the same time, in my example here, at the same time that we do the short trade at $29.19, let's purchase a call option at $30 a share. Now, that's not the price, that's the strike price, meaning we have the right to buy Texas Instruments at $30 a share. That is the strike price. Now, no matter what happens, if the stock runs up to $9,432,000, it doesn't matter. However high the stock goes, you have a contractual right to purchase that stock at $30. What's your maximum risk now? Well, it's just the difference in $30 and $29.19. Not too bad. Less than $1. Do you understand now how the call option is an insurance policy for the short trader. Peter says, is there a name for this strategy? Yes, Peter. It's called buying calls as protection. You're just purchasing a call option for the purpose of protecting or insuring your stock. Okay, now I'm not done. That is the buyer. How many sides of the trade are there, ladies and gentlemen? There's a buyer and there is a seller. Why the heck would somebody want to sell you a call option? Frank, why would you want to sell a call option to somebody? The answer is because it creates income. You make premium from it, okay? And that's what the seller of the call option does. So let's say that the seller of the call option is looking at this trade and says, yeah, that trade's going down, baby. I see it going down, 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 down. And the seller is equally bearish. You see, the buyer of the call option was bearish with a fear of bullishness, but the seller here says, no, I think that trade is going down, 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 and I'm fine with selling the call option. The seller of the call option takes the risk of the short trade in exchange for the premium. The seller of the call takes the risk of the short trade in exchange for the premium. So what does the seller want? The seller wants the stock to keep going down. The seller of the call wants the stock to keep going down. Let's do a quick example here. Let's suggest, I'm making numbers up, but let's say that we sell a call for $5 a share. Now we've become obligated to purchase the stock. I just lied there. We've become obligated to sell the stock. Please forgive me. We become obligated to sell the stock. Okay, so making up numbers here, let's say that this was $5 per share here. Sorry, not $5 a share. It was a $30 something. I forget. Where did we say this price point was? Did we say? We'll say it was $30 a share, but the premium that we receive is $5 a share. Okay, so we're going to sell a call for a $5 per share premium. We've now become obligated to sell the stock at $30 a share. What do we want to happen? We want the stock to keep going down. Why? Well, if the stock goes up, we have to sell the stock at 30 to the buyer that we just sold this call option to, right? So we don't want the stock to go up. We want the stock to go down, and while the stock goes down, the price of that option is going to go down eventually to zero, and that will make our trade happy. In other words, we're short the option. But now I'm getting a little bit more complicated here. But Frank, this is what a covered call would be. A covered call is when you sell the call, you take on the risk of that short trade, but you're covered if you also own the stock. So Frank, again, you can go back to class number 8 to review the covered call. Okay? My point that I want to teach you here before I spend a lot more time on this, because I'm looking at the clock and concerned I'm going to run out of time. My point I want to make here is the seller of the call option is taking the risk of the short trade. That's the most important point. Now, why they're taking it, it's almost beside the point at this moment. The most important thing is that the seller of the call is taking the risk of the short trade. Okay. Now, Valerie says that I have lost her on the premium. Valerie, whenever you purchase a call option or any option, you pay a premium. You as a buyer pay a premium, and you pay that premium to the seller. And again, I'm going to talk about pricing of options a lot more in the next class, Valerie. So just hang with me. Trust me. You don't necessarily have to understand where the premium came from. Just trust me at this point, and we're going to talk a whole lot about it in the next class. All right, now let's move over to the put option. The put option, remember, is the right to sell. The put option is the right to sell the stock at whatever specified price it is. And that specified price is, again, what we call the strike price. That's the specified price. Okay. Now, why would a put option be valuable? Put option, again, is the right to sell This would be beneficial if you were in a long trade. Let's say that you purchased the stock. And let's say that you looked at this trade and you thought it was just going to keep going higher, and you jumped in way back here. And you really thought this stock was going to keep running up. And in fact, it did. It traded higher. And then before you knew it, it made a double top. And then it made a double top, and it just, oh no. And you're just crying like a little toddler. And you're saying, if I could only go back in time and sell. I certainly would sell, but now that I'm all the way upside down in this thing, gosh, what do I want to do? I think I might hold it. Let's see if it goes up. Then, of course, let's see if Ben Bernanke will give us some stimulus and make this market go up. No, it didn't even work for my trade. Oh, it's getting worse and worse. You're eating Rolaids by the gallon, and it's hard to lose money. I know. It's the worst thing you can possibly do. You just don't want to do it. Because it plays with your psychology. So what would be a really great thing to do if you're a long trader? Lower your risk. You say, well, how could I lower my risk? If I don't necessarily want to go back in time, I would just like to have the right to have locked in that price. So let's say that we locked in the price with the right to sell in the event that the trade went drastically against us. It's just kind of like a little insurance policy. Now, this would be extremely valuable to the long stockholder, to the long buyer. The right to sell the stock in the event that it went down. Now, what's going to happen to the value of that put option if the stock goes down? Let's say that this put option was for the right to sell at, we'll say, $85, and the stock came tumbling down to $45. How valuable is this premium now for this option? Valerie, how valuable do you think that option would be? What would it be worth to you? At a minimum, it would be worth $40. Minimum. Because that's the difference in the strike price and the new price of the stock way down here at $45 a share. So this option, in this case the put option, becomes a hedge, becomes an offset. In the event that the trade goes down, the put option goes up in price. The value increases as the stock decreases. Now, let's look at the scenario that this creates for the long trader. The buyer of the put option has taken a potentially good size risk of a long trade, and he has limited the long risk by having the right to sell at a specified price. So now the trade can go against this trader as much as the trade wants to. He doesn't care because he owns puts. And those puts are offsetting the trade. So if the trade runs up, great. Unlimited reward. Unlimited reward. And the limited risk has become very limited all the way down just to your put, where your hedge kicks in and offsets the potential loss. Now the max risk is the difference in the purchase price and the strike price of the put. How many of you think you understand this concept? If not, let's go to a chart. Take a look at the Sears trade. Sears trading down into support level around $45 a share. Does it make sense after hitting support 3 times and bouncing and making a high and now making a higher high? Does it make sense that a breakout would suggest a bullish trade? And of course, the answer is sure. It suggests that it would be a bullish trade. Okay, so you decide to purchase long at $62.91. Now, what's the most you could lose? If you buy long at $62.91, the most you could lose is all the way down to 0. In other words, $62.91 is your maximum risk. Now, how much profit could you get? You could theoretically have unlimited profit. Theoretically, unlimited profit. But what happens if you say, I don't want $62 worth of risk? Now, if you're only trading 3 or 4 shares, it's one thing. But what if you're a big position? What if you have 1,000 shares? That's $62,910. How many of you want $62,000 sitting there saying it could go down to nothing? Or worse, what if you had 10 629,000 shares. Your risk has just become $629,100. $629,000 on one trade. That could be risky. You're starting to see the idea here. So what does the long trader think to him or herself? Gosh, if I could just limit my risk. Well, where do you think it'd be a good idea? Well, I could see buying the stock, and I could see it continually channeling through here before continuing to break out. So if the stock trades way down here and then it were to go bearish, I think I'd be in trouble. I could stop out, but I like owning the stock. I think I'll just hold the position and have myself a hedge. And so from $50, which is my strike price, by $50 or by puts at $50 strike price, from $50 down, you are hedged. Whatever happens to the stock, no matter how low it goes, you have the undisputed right to sell at 50. So your maximum risk has now just become $62.91 down to $50. In other words, it's $12.91. You just cut your risk by a massive fraction. Can you understand why somebody would want to buy puts? Do you understand the insurance part of this? You're simply taking your risk and you're offloading that risk to somebody else. Who? You're offloading that risk to the seller of the put. The seller of the put option, you're the buyer. The seller of the put option is taking on all of the risk of the long trade. Why do they do it? Because of the premium. The seller of the put option receives a premium. They get paid to do it. They're looking at it and they're saying, yep, this trade should go higher. In the event that it goes against me, I'll have to buy the stock, but that's okay. So the seller of a put option wants the stock to go up, thus creating a bullish scenario if you're selling puts, okay? Now that you understand this, take a look at this picture. Two types of options, the calls and the puts. The function of a call option is the right to buy. The function of a put option is the right to sell. Consequently, if the stock goes up, the call option will increase in value. If the stock goes down, the call option will decrease in value. And I just realized that Shane did not paint these arrows right. So I don't wish to blame Shane, but it was Shane's fault. He did my graphic for me, and he forgot to turn my arrows upside down. So those red arrows should be going down. Forgive me. Red down, green up, okay? And then same thing down here. These green arrows need to be going up, okay? Anyway, you guys get the idea there. The call option is the right to buy. If the stock goes up, the call goes up. If the stock goes down, the call goes down. The buyer of the call is bullish. The seller of the call is bearish. The opposite is true for puts. Puts are the right to sell. If the stock goes up, the put goes down. If the stock goes down, the put goes up. The buyer of a put is bearish, making a profit while the stock goes down. The seller of the put is bullish, expecting the stock to go up and the price of the put to go down. Makes sense? Charles says that the arrows are correct on the material. Well, that means that Paul caught the error and did not tell me so I could fix the slide. Boy, isn't that funny? That's all right. We'll fix it. I'm actually really thrilled that the notebook is correct because that makes it a lot easier. Now I don't have a whole bunch of you with bad notebooks. All right. You guys understand this whole concept? How many of you feel like you understand the idea that when a call or when a stock goes up, a call goes up, and if the stock goes down, the call goes down, and if the stock goes down, the put goes up, and if the stock goes up, the put goes down? You guys get that idea? There's two sides, the buyer and the seller. You guys can just study this chart and kind of pull it all together. Now, the important thing, let me just kind of pull all this into a climax for us here. The important thing to understand is just because options were initially created and used as an insurance policy where one person took their risk and offset that risk by passing the risk along to the option trader, what was discovered along the process is that person who sold them, the speculator who said, hey, I believe that this trade's going to keep going in that direction, so I'm not worried about selling them the insurance policy, that policy started to have value. And as the prices go up and the prices go down, those exchanges provided a central location through which we can start trading. And now we get into the world of options trading. So what happens is these options exchanges, specifically CBOE, provide a central trading location where the buyer and the sellers can get matched up. And of course, the exchanges create standardization for the option contracts, as we've already talked about tonight. And what happens with those standardized option contracts? Well, it attracts more buyers and more sellers. Therefore, we have more liquidity. And now we've solved the problem of having an insurance policy on our stock that we could not get rid of if we needed to. I like it, and so do you. More importantly, not only do we like it, it gives us an opportunity to do several things. For a stock trader, the option gives the trader the opportunity to manage their risk. But for an options trader, maybe we'll call them the speculator, they are not concerned about the stock one bit. What's an option trader care about? They are speculating on the future price of the option. You say, well, how do you know the future price of the option? Well, you're going to know the future price of the option by learning how to interpret the stock information and trade the stock accordingly. But instead of trading the stock, the options trader is just going to trade the option, understanding very clearly what we just talked about, that the option prices increase and decrease with the price movement of the stock. So consequently, as those option prices are increasing and decreasing, the option speculator has the potential to make a profit or a loss. Now you say, why would somebody want to do that? Well, obviously, it's a capitalistic opportunity, and that's really all it is. That's the beautiful thing about the financial markets. In fact, the more you study the financial markets, the more you'll discover, in some way, shape, or form, the majority of financial instruments are a way to manage risk. I'm going to go on a soapbox here for a brief moment. Think about it here. Most of the financial instruments outside of pure commodity trades or pure stock trades are ways to manage risk. For example, a futures contract is a way for a commodity buyer or seller to manage the risk of the commodity. That's what a futures contract is. Stock option contracts are ways that the stock trader can manage the risk of their stock or their equity. Now, let's go a little bit further here. What did banks do so that they could try to manage the risk of their risky home loans that they were managing? Well, banks, they got into these risky home loans. They had all these mortgages on the books, and they said, well, all these mortgages, this can't be good for the bank. What can we do with it? Let's bundle them together, and let's create a security. This will create some liquidity for our cash, and it will offload our risk to a foreign investor. Consequently, we ended up with what we call mortgage-backed securities. Thank you, Federal Reserve, that they're now buying all these mortgage-backed toxic securities. Oh, don't you love the Federal Reserve? What is a mortgage-backed security? It's a way to create more liquidity and to offset risk. And for the most part, almost all of the instruments that you look at, anything we call a derivative, is for the most part created as a way to manage risk for the initial underlying asset. But at the same time, it creates an opportunity for traders just like you. Because as the price of the options, coming back to the world of stocks and options, as the price of the options fluctuate with the movement of the stock, it creates a profiting opportunity for you to not ever deal with the stock, but rather to just trade the option. Now, that's interesting. Now, how do option speculators help the overall market? Well, number one, and possibly most importantly, option speculators provide extra liquidity. You see, if the option market was limited just to quote-unquote insurance policies, if the only reason that people were wanting to trade options was to offset their risk, we would actually not have a very liquid market. It would become a problem because everybody would be on the same side of the trade for the most part. They'd be saying, well, we're willing to trade this, we'll say this call option assuming the stock is going to, keep going down. Or we'll say this put option assuming the stock is going to keep going up. And so you don't have a whole lot of buyers and sellers in the market. By allowing the speculators to come into the market, it creates extreme liquidity. Meaning it becomes very easy to get into, or relatively easy to get into or to get out of these derivative positions of options. Now, the cool thing about options traders as a speculator is you can speculate both long and short. Whenever you open a new trade, you're buying a long position. When you sell a new option, you're selling a short position. The long position of the option expects the option to go higher. The short position of the option expects the option to go shorter. As a speculator, someone who's just trading the option, you are not concerned about ever taking possession of the stock, but rather simply concerned with trading the price fluctuation of the option. And this is a very important point that I really want to drive home. Coming out of our old legacy foundations of stocks and options, a lot of people were getting confused. They kept saying, well, when do I take possession of the stock? You don't. I mean, you can, but you don't need to. The majority of options are closed before possession is transferred. The largest majority of options are just simply traded. That's it. You buy it to open, you sell it to close, and that's it. Much like the futures world. In the world of futures, and I know we're not talking about futures right now, but here's a statistic for you, 98% of futures contracts are never set up to actually take possession of the underlying commodity. You hear these horror stories, which really are few and far between, but these horror stories of somebody that bought, I don't know, however many pounds of chocolate, cocoa, right? And they forgot to close their futures position, and they got a truckload of chocolate delivered to the door. First of all, it's a myth. They're delivered at a specific location, but that's another totally different story. My point is, the only reason you're going to end up with a whole bunch of stock or a whole bunch of cocoa, in my case of my futures example, where I probably shouldn't have even gone, is if you don't close the position. The majority of all the positions are closed, and it's not a big deal. In fact, a lot of your brokers will just close them for you, depending on the scenario and what you've got set up. Bottom line, let me get back on track here because I'm clearly getting off. Option speculators, that is traders who just want to trade the option. You don't care about taking the possession of the stock. All you care about doing is trading the price fluctuation of the option itself. That's it. So people say, well, I got